Are markets actually heading for a correction? Stocks were down, inflation was up, and concerns of stagflation are now starting to creep in. But it was the last 8 times that we've seen this happen that we need to be paying attention to. And more importantly, the options market, which is potentially moving into a negative gamma environment. Today, we'll discuss inflation concerns, the tax day coming, what's going on with the Fed, and of course, the key levels you need to be watching. But squeezes are coming across markets, and that means opportunity for all of us, whether you're a trader or an investor. Let's get into it together right now. Well, welcome back everyone to The Daily Show. My name's Tom. Today we're discussing stocks, commodities, and cryptos together. Remember to subscribe and hit that bell icon if you love markets like we do. But let's get into it together right now, including the macro coming up in today's show. It was down across the board when it comes to growth over the last session. In particular, small caps did not perform well, including clean energy and solar. But it was the ones that we've been talking about, those reinflation plays or stagflation positions. Energy, gold, utilities, and metals. We've discussed these for weeks, and I'd like to think quite a few of you out there have been making some great decisions on the charts. But let's get into what really is going on, because of course we posted over on our X account, follow in the links in the description down below, some information about the S&P 500. The last 8 times that we've seen a 1% gap down, the S&P 500 has re-gapped back up with a big bullish momentum. Will it occur this time? Today we'll look at the options that I think will have everyone very surprised, because puts are coming back big time, and if we do not hold these levels, we could turn into a negative gamma environment where the biggest players in the world are needing to hedge towards the downside. The daily 20 moving average as well will be something you need to watch. As we always say, this is the most important bull read on the markets right now. So let's take a look at where the opportunities still lie. Well, it seems like real assets are really low. Since 1925, we have never seen a lower price for real assets in comparison to stocks overall. And we know that in stagflationary environments, we generally have incredible performance from gold, commodities, and even value stocks. So should this be where we're placing the money right now? Well, take a look here at all of the gold and silver indices versus their moving averages. That is green across the board. And as we've mentioned, gold stocks in particular have been amazing recently with some great returns, beating out semiconductors and other sections of the market. You can also see here the Dow gold ratio, which has been dropping off, which basically shows you that gold has been improving versus the stock market across the board. What about the sentiment in markets though? We've talked a lot about how the Twitter sentiment, the AII sentiment has really been favoring the bulls recently, but did you look at the asset allocations? People's cash asset allocation has dropped drastically and bond allocation has dropped even more. And what this shows sometimes is complacency in markets. Now, a lot of the time when we see bonds kind of drop out and we've got somewhere around this huge percentage here of growth or stock allocations, we tend to be on that topping for the retail trader or investor. Now, does that mean the markets are going to crash? No, but it could bring a correction. And of course, if we get through that daily 20 moving average, it may bring down some of the semiconductors and some of the other hot AI stocks at this stage. Energy stocks though, well, they're absolutely rampant. The percentage above the 50-day is now at 100%. And as we've been trading and talking about this for a while, all of these areas have been improving, including utilities, which is now at 93% of stocks above the 50-day. When we look at overall the 3-month, 6-month, and 52-week highs, though, it may just be getting started still for a couple of these sectors. Members in a new 52-week cycle high for energy is only at 64%. Financials are more like 86, showing that they're probably getting a bit stretched. And of course, information tech has already been stretched for some time. So are there more opportunities on the horizon? Absolutely. And rotation is clearly alive and well from the perspective of what Wall Street's doing. Before we go to options, let's have a look here at CRB Commodity Index, a new 52-week high. Again, strength usually means further strength is coming, and it makes sense for some of the seasonals as well. Goldman Sachs putting out a report recently that shows that when they believe certain areas of the market are overvalued, we tend to get lower returns between 2 and 3%. We'll show you that why in presidential years this makes perfect sense, plus with the overlays of over 100 years of data, it also seems to hold up. So did you buy the daily 20 moving average? This has been the zone for bulls to get back in. and it was again holding up. The put wall sitting around 5,200 was holding for the S&P 500 over the last 24 hours. But do remember, this daily 20 has really meant everything to this particular market. And if we do manage to close below that, it's a monumental event that's most likely going to move us into a negative gamma environment. It's also going to bring in the idea of a 5,000 or even a 4,700 pullback. And in both these cases, if we did get this low, we are still in corrective territory, which is still a bull market. Are they great opportunity levels? Yeah, I'd like to think they are. But let's have a look at who won over the last 24 hours in the markets. And we can do this by having a look at the 5-minute chart. So you can see here that the markets basically opened up, they gapped down, and they sat around at these levels. Now, when we look at the Qs, which we'll look at in a moment, that really shows you that we might be looking at what we call an island reversal. And what an island reversal is it's a gap up, sitting around at a range, and a gap back down. A very strong rally through the end of the session makes us think that buyers are trying to get back into control because, of course, buy the F and dip is live and well when it comes to these markets, and that's what everybody has been doing. But when we go to the Qs, which we'll do right now, you can see that it's looking more like an island reversal. Gap up, gap down, underneath the 20 here, although that doesn't mean anything on this chart. We've seen it's been invalidated many times. And again, it closes near the high. A new low under any of these zones is going to be incredibly important. So for the SPX, what we want to be doing is marking out that low and marking out the 20 moving average. And this comes in at around 5180, which you'll see is very important based on our futures market structure. So which levels matter over the next 24 hours? For bulls, you're going to want to regain this level here. If you do, because we're in a positive gamma environment right now, a 5250 is very important. But you'll see in a moment, the puts are big and they are everywhere all over this range down here. If this range doesn't hold and we move through that 5180, 5175, the structure over here, we could be turning into a negative gamma event on the 0 DTE options expirations. And this will push a 5090 and possibly even break of the 5090 level. Remember, this is also where the daily 20 moving average is. So there's a lot at stake here in terms of options and technical zones. For bears, you're going to be wanting to look for shorts around the 5234 level. It is also the most traded recent zone. And of course, for the call walls, let's take a look together at where the markets could push if they keep rallying up. First up, 5200. Look at this. For the expirations on the 3rd and the 4th, this is the zone to be watching. Put support at 5200 is huge, and there's way more puts than calls now in this market. And this is a huge switch from where we've been only a few weeks ago. Take a look here now as well at the 4th of April. It is absolutely flogged with puts. And this is a pretty important level because if we manage to take out 5200, I think more importantly 5175, that's pushing in the concept of 5140 quick move, and then of course 5090, 5100 being the next major kind of level. And I think that if we take out 5175, we're more than likely moving towards the 5100 zone, as that's the next major support on the technicals. It also makes sense from a lot of the options, but with non-farm payrolls or the jobs numbers coming up very soon, all of this has us wondering, okay, is this really the change of events? Now, from the bulls perspective, you're just going to want to say, well, if we hold 5200 and we see bouncing back up again, then we're still in a positive gamma environment for now. So we're still squeezing higher. That's absolutely true. And if we do manage to find buyers that push through some of that market structure, then they're probably going to win out. And it's going to be more of just buy the dip. So what an important level. We've never seen so many puts floating around at these zones ever since pretty much the start of 2024. So I'm certainly watching, and I'm sure all of us are going to be linked in to these particular charts because they're so important over the next couple of days. Does this make sense to what's happened in the past? Well, it kind of does. In presidential years, we tend to see sells that happen in March and April. It didn't happen. But what we do know is that we have usually a sidewaysing market. Now, if we look at the most closely correlated, like we've talked about several times, we basically come out with 2012 and 1976. And in both of these circumstances, markets started to struggle around this time, either pullbacks in time during 1976, a stagflationary kind of period, or pullbacks actually in the market, which ended up resuming back into bull trend. So it comes out with pretty good stats that could be what happens. For semiconductors during the month of April, just remember this is technically a weak month. And although April is one of the better returns overall in the markets, it's not usually led by a lot of the tech stocks. It's often led by other sections of the market. When we're talking about stagflation, at this stage, it doesn't look like we're in it. Obviously, the GDP growth is still forecasted to improve, although this is basically starting to lessen a little bit. GDP is being improving, and most forecasters are now believing that everything is looking really good in the US. What about June rate cuts? Well, we can see here that the idea of a rate cut is at 63% according to the market, and 63.49% is the idea of an ease. No change is sitting at 36. A lot of changes going on here in the rate cut. Do we get one in June? Hey, the markets have been changing so much. I like to think, let's not predict necessarily if it's going to happen in June and out. Let's actually look at the price action and really follow that more than the narratives that are coming out about inflation, about everything to do with, what's going on with interest rate cuts. We already know that metals, energy, and gold have been running strong for about a month, and that a lot of the opportunities in the market that have been best haven't even been in the US market, and in fact, they've been in some of the emerging and overseas markets themselves. US Treasury issuances are starting to get a little bit out of control. A lot of people are sharing this chart. We have 21 trillion of T-bill issuances in the past 12 months, with, of course, the reverse repo market coming down. There's been some support for it, but treasuries are barely holding on to a very important support, and we'll look at that later when we take a look at the charts and go through the analysis there. During presidential years, this is what tends to happen. You can see that April actually isn't as good as you would think because we get the sideways market, and May can be sell in presidential years, while we also get very, very strong June, July, Augusts. A lot of ways to cut this data. If we take a look here at what tends to happen in every year, these are the results. So you'll notice that April is usually quite strong. I think price action is going to be the key here. Goldman Sachs, they're pricing in a 5% plus move as a pretty likely probability. We've already talked about this chart several times. 25% is their expectation, and the market still isn't pricing in much fear. And the reason is quite simple, that we have most stocks doing very well. Almost everything's kind of approaching those 52-week highs, and it's really showing you here that the market is very euphoric. It's feeling pretty good, and maybe it's due for a pullback, but again, price action will be the detail for this. Nothing will happen until we get through those options levels. NASDAQ 100, when we have runs like this, is the 5th longest in history above the 200-day. You'll notice what we go into sometimes structurally lower markets. Basically, they sit round, they go up, down, and all around, and there's a lot of rotation that starts to occur. The same thing for the S&P 500 after we see a 10% back quarterly gain. A lot of the time, it needs a bit of a cool off. You can see here a lot of the stats are pointing towards little cools, longer cools, even pullbacks themselves. And this tends to be, again, what happens in markets. Are we due it? Yeah. It's 67 days on average for a 5% correction. We're well over 100 at this time. Again, if you look back into the history, 1928 to present, the bull market cycles, even the period of time that we're in when you cross-correlate them, all of these are pointing towards generally sideways style markets or pullbacks in time around this period. Let's take a look at the biggest volume trades over the last 24 hours. There was a big one that came in for the Russell 2000, number 12. It's a dark pool sweep that came in after hours. You'll also notice that we have two other huge trades that have happened. In both of those cases, we ended up shorting off. This time around, it's happening off a pullback. So you may think it could be a buyer. Maybe it's someone actually dumping their position. Very tough to tell here, but a big trade nonetheless that I thought we'd report on. CTAs, let's give an update. S&P 500 CTAs marginally dropped position, not that much yet. NASDAQ also marginally dropping the position. Again, not that much yet. Brent remains incredibly bullish. And as we've mentioned, oil has been ripping. So this is just another occurrence where we follow sometimes the CTAs with our price action. And if they both agree, it's really nice to see. The VIX also remains very important at the 16 level. So as we've talked about, if we manage to get through 16 on the VIX, it could create a short squeeze on that particular index. And then that may also coincide with the daily 20 moving average being taken out I think at that point, there's going to be tons of volatility in the markets. It's going to get incredibly exciting for day traders, and I am very keen on seeing what happens next from that perspective. What else is going on with jobs workers? Well, we know that this week is non-farm payrolls, the US jobs. Job openings have been dropping recently, and you'd have to think that's going to start showing up in the numbers. Remember, the unemployment numbers are always lagged. So even though the market might be reacting off it, they already basically can figure it out. So it's really an excuse more than anything else. And it's more about what the Federal Reserve is going to do. Are they going to give us a cut or no cut? Let's look at the charts to figure that out as well. The VIX 16 set the alert. This is a squeeze area. Very important we get a daily close above the 16, and that's going to be a huge zone for it. The central banks around the world have been reducing their overall support of markets, but over the last kind of 24 hours, they did increase the support of the markets. Now, I'm pretty sure that's because things are starting to get a little bit cracky. If this starts to turn down, again, if it turns down with the daily 20 moving average being closed below on the S&P 500, I think that'll be a huge deal and we'll need to be paying attention. The US 10-year, 4.35%, breaking through to a new high here and very, very strong. Now, if we see yields across the board keep spiking up, that's great for the inflation-based trades. That's great for the rotation that we've been seeing, but it's not really that fantastic for small caps. As we've already seen, they suffer during these high interest rate environment periods. And it may also be the straw that breaks some of the mag stocks as well. So this is a huge level for the markets. Watch all the yields moving forward. Now, why are we watching yields? Well, it has a lot to do with risk on and risk off sentiment. We know that high yield bonds, what do? Well, high yield bonds effectively show us what's going on in the markets, whether it's a good market or bad, and they're back to the support. Now, it's fine if high yield bonds coil or go up and the markets go up. That's very good. But if bonds markets start to drop off, yeah, you got to be concerned, and you really will be wanting to mark in things like 76.59 on HYG, because if it drops below, it's going to be kind of weak. We're also tracking options volatility in the bonds market. We're looking for a new high. We haven't seen it yet. I would suspect that we would only see a new high if we break through the daily 20 moving average on the S&P, and we will be tracking it very closely together. The American consumer discretionary versus staples, that remains kind of holding through. If it breaks below the 2.35 barrier, again, it could be showing cracks in the markets. And do also watch things like the Dow Jones Transportation and home builders. Home builders have been on an epic run. And again, daily 20 moving average seems to be one of the big things here. Always holding above this zone. If we start to weaken through it, could be signs of a further corrective move in market. So things are starting to look a little bit weird here. The dollar index is also bulling, which shows us that we've got higher rates. We've also got the idea of maybe some risk off. This dollar move, I think, is really important. It's leading into the idea of 105.50. And at this stage, if I was technically looking at this chart, which I am, I would say that is the more likely scenario. Even though we haven't made a new high yet, usually when the dollar's done what it's done so far, it will move towards the next level of equilibrium, which I believe sits around the 105.50. So some pretty good levels there. Gold, even with strong dollar, has been phenomenal. And this is almost at our target. We talked about the flag. Gold is almost hit 2,300. My longer term target and all of ours is probably a little bit higher, but 2,300 on gold, this is getting in that point where you should be breaking even those trades. And if you got into this last week, well done. It's done better than crypto. It's done better than stocks. It has been a phenomenal little trade. And silver seems to be getting warmed up as well with a huge breakout over the last 24 hours. This has been where silver has squeezed quite a few times. Next stop, 2780, question mark. This is certainly the next level that you'd be looking at. This is one of our trades of the week, and silver already was showing signs of life, but that was a huge 24 hours. And let's just have a look at the percentages for silver. It actually went up 4.18%. We kind of call silver like the Ethereum to gold, and this tends to lead into further rallies. Now, weekly closure will be all important to make sure it holds through and breaks through this zone, but you'll notice the last structure we had was sitting around that 2780 level. So it opens up the idea that silver could be in some type of squeeze at this point. Gold stocks did well. They held up post-market. They also moved higher. This is good news. We love gold stocks versus gold at the moment. Super undervalued. Put your GDX versus gold spot. You'll see what I mean. Otherwise, watch about 2 weeks ago. We've been talking about it for a while. US oil keeps its 2 step forwards, 1 step back. Very nice rally. looking for oil to higher levels, loving the 88 kind of targeting zones here for the barrel. JP Morgan, a few others coming out with $100 targets now on oil. And for day traders, it remains pullbacks to be met by bull demand unless something changes. You could argue that we've hit into a little bit of a technical resistance here, but I still think that there's even more chance that gold, or oil in this case, I've got gold in the mind at the moment, guys, but oil at this stage could be moving up. And that's because CTAs have been doing quite well. Semiconductors versus the SPY. This is a combo that we are watching very closely. Daily 20 moving average, again, has been holding it up. If it breaks below at the same time that the S&P 500 does, this is the strongest section in the market. If it starts to weaken, it lets everything start to kind of come through. Mid caps also struggling a little bit for the first time in a while. Still bullish on mid caps, and I think they're a very decent area for the market if we do get a corrective move. But mid caps were down over the last session. XLE wasn't though. Massive moves here from the energy markets. As we've been talking about, we've loved energy. We've loved the rotation into it, and these stocks are blitzing. So is there more to come? Well, you wouldn't go against a trend like this at this stage for energy. Same thing with metals, precious metals in particular, emerging markets, something we'll be covering on this channel soon, because if we are going into a hyper boom for rare earth minerals, that can be a very interesting area, but metals have been doing well. Let's jump on over to the charts now and have a look at the single stocks before we go to indices. And Tesla was not a great report, eh? Look, probably most people thought about this, but the defended area defended up. And I think day traders will be very interested in the next session. You know, this market has been suffering for quite some time. What if we see a new high? And I've kind of liked this area for Tesla. Most people, of course, hate the stock at the moment and they say everything's terrible. I understand, but it's also one of the worst performing stocks on the S&P 500 this year. At some points, it has been the #1 worst S&P 500 stock. So at around these levels, we know there's buyers. There have been before. We can see here a high and a low and an open and a close that kind of show us that the market did hold the initial freak out. So someone was buying through this area. Volume was higher, so that's important. And if we get a new high, then maybe stops under here or here may be worth day trades to see some momentum, try to get through that gap. But are we out of the woods yet? No, we're going to need a 185 to really show that this market is actually holding up and found its base. One thing that hasn't found its base yet has been AAPL. Yes, the biggest stock in the world at one point just keeps getting worse. And this stock really doesn't look good. We've talked about the weekly. We've talked about the level. Watch out below 165. Again, daily 20 moving average. This could be a double top. If it does get underneath this level, Apple may really weaken. And although I think it will hold up okay versus the rest of the Qs, this really could be the beginning of something a bit larger. So no one really likes this stock right now. It's really getting under some pressure, and we'll continue to watch it. It's not like Google or some of the others that we've followed. We really do like at this stage. SMCI continues to struggle, as does pretty much any of these other major stocks. You can see here, if we put NVIDIA in the charts, all the semiconductors are kind of just floating around. And NVIDIA, interestingly enough, came back to, again, yes, the daily 20 moving average, which has found buyers on every time. So if it closes below there, like any of these markets, they're starting to show the cracks. This is the first time we've seen it in a very long time for these markets. CQQQ and the Chinese stocks continue to look really nice. HSI in particular, we've talked about the 17,000 level. It got up to it. You can see the downward trend line that comes off previous points. Again, very, very strong here for this market. And it's rotation out of some of the equities into maybe, you know, the Chinese or emerging market equities, which are starting to look a little bit more attractive in terms of valuations. The Aussie 200 suffered a little bit from what's going on in the US, but generally the metals, minerals, and energy markets are holding it up. Same thing for the FTSE, and the US 2K really did suffer. So it made a new low. I thought we might see some structural buying around 2080. This is why when you look at a level and you've got a key zone in there, remember we look for wicks, we look for structure. And at this point, have we got any structure? No, it just keeps diving down. In fact, at this point, if the markets actually pull back up to 2100, this market structure here would act as a bear area because it's a supply. And this could be where actually we see rebearing of the zone. Next level for the bulls is going to be around 2030. And here I think it's a question mark at best. So we can't really be loving the US 2K at these prices. If we move over to the Qs, I mentioned before the idea of an island reversal, gap up, quite a few days sitting around, gap down. Again, island reversals are only by themselves. We don't have the next catalyst, which will be taking new lows. But in both cases, to the SPX and the Qs, these are weak zones, guys. And we're certainly paying attention to it very closely. In every other time that we've seen this type of thing, markets have rallied in the next couple of sessions. If they don't and they take new lows, well, we know this time is certainly very different. And of course, the trends are there. For Bitcoin hodlers or people that like Bitcoin, this is one of the last levels for the bulls. I think that this 61.8 is a key level. The 65.1, I talked about it in our Market Masters Club in our pre-market open. I'm looking for structure here. It could be a sign where the bulls are still. If it goes much lower, I don't like it at all. If you're looking towards the bull side, I think that you want really a break above this previous high, which is going to be that V. 67,000 would be a nice level to see Bitcoin regain to show that it's got that bullish momentum. If it makes new lows and doesn't instantly wick back up or do something like that, again, I think bears are getting in control of this market. And if we go through the daily 20 moving average as well in the S&P, that kind of shows us risk off across the board. That will also bring down, many of the stocks that have been running hard, and also crypto could suffer. So watch very closely what's going on, because if the markets come down to this bull zone here, I'm not that bullish on Bitcoin. I think it'll break 60, might even go down to 51K. We'll have to watch the price. For the week ahead, there's a little bit of news coming out. We obviously have the Wednesday non-farm employment change numbers. I don't think they should move the markets too much. If they do, it's more of an excuse. And then, of course, we've got the major jobs numbers coming on Friday at 8:30 a.m. New York time. These will be worth watching, and you must be paying attention. Of course, follow the show if you're interested in finding out more. And I'm really excited to go through the options over the next coming sessions, because I think 0DTEs are just about to get really wild. Thanks very much for watching. Subscribe, smash that like button. We'll see you in the next one. Bye for now, guys. Have a great day.